Oh, it's Brunch with Brian. How are you doing today? So, guys, today is tax day. So it's the day that you're gonna need to get your taxes in. Now, if you did not file your taxes yet, you can file an extension, and that way you can avoid penalties and interest. If you guys, now if you're newer to real estate investing and you're just starting to make money as a real estate investor, it's not uncommon to file extensions with your company, with your taxes. But here's the main thing I want to teach you about taxes. Well, number one, it's probably a good idea as you grow to have somebody, a professional, helping you with your taxes. I don't know if you're still doing your own taxes, but that's probably not the best idea. We've had a CPA we've used for literally, I think, over 30 years, this guy, and he's awesome. Now, he understands everything we do, and that's the other thing. I mean, you need a CPA or somebody doing your taxes who understands trusts and LLCs to some level and understands how to build your entities and pay your taxes and save you as much money. Now remember, you're deducting a lot. When you're doing cash flowing deals, which is what we do, we love these. We call them pre-funded deals because they come with funding attached. They come with either seller financing or there's an existing mortgage on the property that you're just taking over. So we love those type of properties. When you start buying those, you better have a CPA who kind of understands real estate a little bit and how to do this. But you can deduct an amazing amount of things, including your education expenses. So if you are not deducting the costs of your education, the training, your what to say and what to do system, that's training you're doing for your business, your LLC. You have a legitimate business you set up with a bank account, and now that's being taxed. You got an EIN number on that business. So that's the whole key. So obviously when you start to pay taxes on an entity is when it has a social security number and starts making money. So when you get your social security number and you start making money, you have to pay taxes. So your business gets a social security number. They call it an EIN, employer identification number. And then as soon as you form your LLC, you take your articles of organization and your EIN number, which you file with the Social Security Administration, with the government, and you get that back pretty quickly. Down to the bank, you set up your bank account. Now, as this money's coming in, as you're doing your deals, I buried the lead. What's the number one thing you should know about taxes is that when you are doing cash flowing pre-funded deals, seller financing deals, you do not need to ever pay taxes. Yep, you heard me right. That's the most important thing I should have said right in the beginning was if you do this properly, you need not pay taxes on your profits from these deals. Now, how does that work? It's a function of 1031 exchanges and rolling forward the depreciation. Now, that's important too. Now, depreciation, you think, okay, once you understand depreciation, that's a massive tax savings. What you can do, how depreciation works is you take the value, overall market value of a house or an apartment building or whatever it is, you subtract the land value. You can't depreciate land is the government's thinking because it's a piece of land. It's going to be there, come or go any improvements. So your improvements can be depreciated. Usually people take about 10% out for the land cost. Sometimes, your CPA or some people might want to take a little more, but let's say 10% on average. So let's say you have a property that's worth, okay, just for round numbers, let's say you have a property that's worth like 300,000. Okay, now let's take out 25,000 for the land value to get to 275. Okay, so let's say that the improved value, the property, the structure value is 275 that I'm going to depreciate. Now, you depreciate that by dividing that amount by 27.5. The government lets you depreciate an asset, your real estate assets, over 27.5 years. So then you will actually know if the house was worth 275, that would mean $10,000 because you're divided by 27.5. That's why I did it that way. So that'd be exactly $10,000 of income per year that you can deduct right off your taxes. So if you made $100,000 that year, you'd only have to pay taxes on $90,000. Okay, so that's how, depreciation works. So now, but the problem is there's this thing called depreciation recapture, where down the road you have to kind of pay some taxes, not the same taxes you would have paid the first time around. It's dramatically less, but you still have to pay some kind of taxes unless you roll forward that depreciation on a 1031 exchange into your next property or properties. Now that's the key, is that you're trying to find 2 or 3 or 4 or 5 properties, normally 2 or 3, that you can just pay big down payments on and get with some kind of seller financing. So that's the next step, is you're trying to take that money out of your 1031 exchange and buy maybe 3 properties. That way you're tripling your asset base and you're not paying taxes on any of your profits. So that's the beauty of it, guys. And we love 1031s, and when you do this properly, you are expanding your asset base, expanding your income, your monthly income, because 3 income properties instead of 1 income property. And so the key is you have to identify the property within 45 days of selling your other property. It has to be a like-kind exchange, which means, and this is important, guys, you cannot do these 1031s on flips. You can't do it if you're doing rehabs, and you can't do it. Now, if you're doing rehabs, there's other ways to avoid taxes. There's ways to use self-directed IRAs and some other strategies I'm not going to have time to get into today to alleviate some of the tax burden. But normally, guys, if you're flipping a property, it's like short-term capital gains tax is anything under a year. So now, if you are, this is the key with the 1031 exchange, guys, and this is it doesn't get complicated in the code, in the IRS code. It just says held for investment. Okay, so that's all it says, that those 3 words, property must be held for investment. So obviously that's not a flip. If you buy a house, fix it up, and sell it for cash, you were never intending to hold that long term as an investment. Now, now it doesn't say long term, and it doesn't give any dates, and that's the key. That's why this is a little bit nebulous, this part of the code, and that's why you don't know exactly. I mean, if you have lease option agreements drawn up, and the intention was to sell the property as a lease option, then you're safe, okay? And if it's clear, and especially if that's a proven strategy that you've used in the past. But if you are all rehabs, and then you happen to do one and you sell it in 4 months, and you say, oh no, I was holding that one for investment, that might be a harder case to make. But remember, none of this ever comes up unless you're audited. So, you guys sort of decide how you structure these taxes, but I want you to be very aware of 1031 exchanges. And if you have more questions about that, call our office. We have an actual whole report on this, a 1031 exchange report that I created. And I've done podcasts on this, and it's a way to do pre-funded properties, seller financing properties more intelligently, and alleviate yourself of the tax burdens. So again, using and rolling forward the depreciation, as well as doing 1031 exchanges. And if you don't understand what I just said, watch it over again. And you have to identify the properties within 45 days of closing, and then you have 180 days to actually buy them. Okay, so again, 1, 2, 3 properties, however many you can line up to buy, and use that your profits coming out of the your profits coming out of the prior deal towards that. Okay, so use those 1031 exchanges to never pay taxes, but today is tax day, so get your taxes in today unless you file an extension. So that's okay. We end up filing extensions a lot. That's not a big deal, but definitely get going with your taxes today, and learn how to never pay taxes with your real estate investing, with your wonderful, incredible cash flowing properties. Okay, so guys, let's do our deep breathing. Take a deep breath in, nice deep breath in. Oh, what's our affirmation? Oh, let's think of our affirmation while we're breathing. Okay, another deep breath in. I wore my green today because it's tax day. Okay, last deep breath in. All right, good. I'm going to be smart to now you're legally not paying taxes, guys. You are legally avoiding your tax burden, so this is I'm smart about my taxes using 1031s and depreciation. Okay, but we won't say that part. I'm smart about my taxes. Ready? 1, 2, 3. I'm smart about my taxes. Ready? 1, 2, 3. I'm smart about my taxes. Okay, so guys, use these strategies I taught you today. Literally, guys, you do not need to pay taxes on the profits your end profits when you're cashing out of these gorgeous, incredible cash flowing long-term properties. Okay, so awesome day. Until I see you tomorrow, what are you going to keep doing? What are you going to do until I see you tomorrow? Yep, you're going to keep expecting success, getting awesome training, and taking